This module, Pipeline Segmentation, is tutorial number 8 in the series Pipeline Transport and Basis Trading. These tutorials are presented by Paradigm, the leading provider of energy risk management training since 1995. For more information, please visit our website, paradigmtraining.com. In previous modules, we've seen how basis swaps are structured and traded. In this module, we will use basis swaps to synthetically transport natural gas. This will allow us to segment the pipeline and minimize the transport costs along each segment. In some cases, further cost reductions are possible by backhauling, a method to arbitrage the pipeline versus the basis market. This process will identify for us the lowest cost method for sourcing natural gas. A utility in California owns capacity on the El Paso pipeline, which moves gas to Southern California from West Texas and New Mexico. It is looking for the lowest cost method for buying gas to be delivered to the Southern California border with Arizona. It has three alternatives. 1. Buy Permian Basin gas in Waha, West Texas, and transport it to the SoCal border. 2. Buy San Juan gas in Blanco, New Mexico, and transport it to the SoCal border. And 3. Simply buy gas taking title at the SoCal border. The cost-effective alternative will have the lowest cost among 1. Permian gas plus transport, 2. San Juan gas plus transport, or 3. Southern California gas. The key here will be to find the minimum cost of transport West Texas to Southern California and the minimum cost of transport New Mexico to Southern California. Because for each of these transport routes, there will be more than one transport method. We will have to calculate and compare the cost of each alternative. In analyzing transport costs, we will compare the variable or marginal cost of each alternative. With the pipeline, the variable cost would be the commodity charge plus the fuel charge. The alternative is trading basis swaps, in which case the marginal cost is the price difference between selling gas at the receipt point, for example, West Texas, and buying gas at the delivery point, Southern California border in this case. Using the El Paso pipeline, the variable cost will be the cost from Waha Permian to Blanco, New Mexico, which is 27 cents, and from Blanco, New Mexico to the Southern California border. So the total cost for Permian to California transport would be 64 cents. Now let's see what the cost would be trading basis swaps. Basis swap quotes are given here. The need for transport implies that the utility owns gas in West Texas it doesn't need there. It needs it in California. So the utility will sell the unneeded Permian gas at index. To hedge its Permian index position, it will sell a Permian basis swap, paying Permian index and receiving LD minus the quoted 50 cents. Recall that LD represents the last day settlement of the NYMEX Henry Hub futures contract. Utility will buy gas where they do need it, Southern California, paying the SoCal index. It will also buy a SoCal basis swap, receiving SoCal index and paying LD plus the quoted 18 cents. Note that the utility is fully hedged. There is no index price risk. Permian index inflow offsets Permian index outflow. SoCal index inflow offsets SoCal index outflow. And the same for LD. Everything has been offset. What remains is the moving of gas from Permian to Southern California. Receiving a negative 50 cents is the same as paying a positive 50 cents. This totals 68 cents, which is more expensive than the 64 cents cost of flowing gas on the pipeline. Let's refine this a bit further. What if we were to move gas on the pipeline from Permian to San Juan? This we know costs 27 cents. But for the second leg, we don't use the pipeline. We trade the basis. We want to segment the pipeline. The question is, what will this cost? Our Permian gas has been physically transported to San Juan from West Texas. So now we need to sell San Juan gas and buy SoCal gas. Here are our basis swap quotes. Utility sells a San Juan basis swap. It's paid LD minus 17. Utility also buys a SoCal basis swap, paying LD plus 18 cents. As before, all the index flows are exactly offset, leaving only the fixed money amounts. Being paid minus 17 is the same as paying positive 17, So the total cost of transportation for this second segment is 35 cents. Adding that 35 cents to the 27-cent cost of the first segment gives us a total cost of transport, West Texas to California, of 62 cents. 2 cents better than the 64 cents cost of flowing gas over the full route. So now we can compare costs among our alternatives. Flowing gas on the pipeline over the whole route, trading the basis over the whole route, and segmenting the pipe. And clearly the most cost-efficient alternative at 62 cents is to segment the pipe by flowing gas Texas to San Juan and then trading the basis to move it to California. Another possibility is to source the gas at the San Juan Basin and move it on the pipeline to California. We know this will cost 37 cents. We compare this to the cost of transport by trading basis swaps, San Juan to SoCal. But we already calculated that cost just a few frames back. This should look very familiar. Sell San Juan and buy SoCal. Sell a San Juan basis swap and buy a SoCal basis swap. And recall, we ended up with a cost of 35 cents. 2 cents better than the 37-cent pipeline cost. This suggests we strand the pipe. Instead, we trade the basis at a transport cost of 35 cents. But we have a third alternative, backhauling. We will buy our gas at San Juan. We will then move the gas backward or upstream to West Texas by trading the basis. We then move the gas to California on the pipeline. We are to move gas from San Juan to the Permian Basin. So here we sell our San Juan gas and buy Permian gas, thus moving our gas to Texas from New Mexico. So we sell a San Juan basis swap, where we receive LD minus 17, and we buy a Permian Basin basis swap, and we pay LD minus 49. Paying negative 49 cents is receiving positive 49 cents, and receiving a negative 17 cents is paying a positive 17 cents. So the utility receives 49 and pays 17. The net of this move is an earnings of 32 cents. So we will earn 32 cents moving gas to West Texas. We then move the gas all the way to California on the pipeline. That cost is given as 64 cents. That implies a total cost of transport of only 32 cents. This is a lower cost than either of our first two alternatives. But this 32 cents has us moving gas on the pipeline all the way to California. We learned earlier that there is a more efficient way to do that. So here's what we're going to do. We still move gas to Texas by trading the basis swap. But we only flow gas on the pipeline back to San Juan. From San Juan to California, we trade basis swaps. So we earn 32 cents from backhauling. Pipeline transport back to San Juan costs 27 cents. And San Juan to SoCal basis trading adds 35 cents, making our total cost 30 cents. So we have four alternatives for San Juan source gas. Flow gas San Juan to Southern California. Trade the basis San Juan to Southern California. Then backhauling, trade basis to Permian, and then flow gas to Southern California on the pipeline. Or finally, backhauling to Permian, and then segmenting the pipe, using the pipe for the first segment and trading the basis for the second segment. Of these, clearly, backhauling plus a pipeline segmentation has the lowest cost. In this example, both backhauling structures offered lower total cost. Now, why would that be? Well, look at what's being done. Moving gas San Juan to Permian pays the utility 32 cents. This is by trading the basis. Moving gas back from Permian to San Juan costs only 27 cents. They end up exactly where they started, but 5 cents richer. This is essentially an arbitrage of the pipeline, exploiting price differences for transportation between the physical pipeline market and the basis market. Now we have identified the lowest cost transport structure for sourcing gas both at San Juan and the Permian Basin. To determine the cheapest way to source gas at any point in time, The utility will compare and choose the lowest of buying Permian gas plus 62 cents, buying San Juan gas plus 30 cents, or simply just buying Southern California gas. So to summarize, we say that pipeline capacity owners can incur the lower of the Priceline variable costs or the costs from trading basis. Now this can be refined by segmenting the pipeline. Transport costs can be minimized by allowing us to optimize the cost of each individual segment. And at times, backhauling can further reduce our costs because we can use it to arbitrage between pipeline and basis markets. So what's next in the series? Well, earlier we learned that pipeline capacity meant that you had two trading positions. You were long a basis spread and you were long an option on the basis spread. We're going to utilize that now and see how we can trade for value around these risk positions. And we're going to see how we extract value from pipeline capacity using these risk positions. And we'll look at how to monetize the extrinsic value from the pipeline optionality.
Paradigm offers training programs on a wide array of topics. All of them address the unique challenges of managing risk in the energy sector. We invite you to our website to view more modules and to learn more about Paradigm's online tutorials and classroom training programs.